Good evening, Bruins, and welcome to tonight's Second Act. Second Act is a program that started in the fall of 2016 and is designed to offer Bruins in their fifth decade of life and beyond the opportunities and resources to engage, learn, optimize health, volunteer, and invest in themselves. Many of the topics that we share are ones that you suggest, so please continue to let us know what topics you're interested in learning about. Now, I want to thank Wescom for sponsoring Second Act and for participating in tonight's program, Retirement Basics, Building a Comfortable Lifestyle for Tomorrow. I also want to thank Irvin Rodriguez, who is participating from UCLA Gift Planning. Now, I would like to introduce Sal Murguia from Wescom.
Thank you for that introduction, Jeanette. Good evening, everyone. My name is Sal Murguia. I'm Partner Development Representative with Wescom Credit Union. So glad to be here this evening, and we're the sponsor of this event as well. I hope everyone can hear me okay. I know that we're recording. And before we jump into our featured speakers this evening, I just want to share with everyone a little background about Wescom and the partnership that we have with UCLA and how we became a sponsorship for events such as this. So if you don't mind, I'm just going to share my screen, and I'm just going to go through this quick little presentation to share with you. So Wescom Credit Union was established in 1934. We're one of the largest credit unions in Southern California. As you all know, I'm sure a number of you know that credit unions are non-for-profit organizations where we offer similar products and services as banks, but since we are a non-for-profit, the profits that we do make, we give back to our membership in the form of lower fees and lower rates. And being one of the largest credit unions in Southern California, that means that we have a good branch network, and that's 24 Southern California branches to offer to our membership. The Wescom Credit Union and UCLA. Well, about 5 years ago, Wescom and UCLA joined in a partnership, and Wescom became the official banking partner of UCLA Athletics, Campus Life and Recreation, and the Alumni Association. We also support staff assembly and ASUCLA initiatives. And our goal with our partnership with UCLA is to build better lives for Bruins and the Bruin community. So we want to be a resource for the Bruin community that includes staff and faculty, students, and alumni. And our goal is to help create financially healthy habits and make banking easy for all the Bruins throughout their walks of life. We just have, want to be really quick on this. We do offer various savings accounts and checking account options. You can see up here that we have free fee ATMs, over 30,000 nationwide. And we also offer a bunch of just various savings accounts where you can save money with us, including shared certificates, money markets, and IRAs as well. When you bank with Wescom, you can bank with us from anywhere with using our online and mobile banking options. We also have Snap Deposit and Zelle. And like I mentioned, we're part of the ATM co-op ATM network. We have over 30,000 ATMs nationwide. We also have lending options to fit your budgets. You know, a lot of people ask, well, why do you go through this if you're a financial institution? Well, a number of credit unions don't offer the same sort of robust products and services that you would find at a typical bank. And what we want to tell people when we're telling the Wescom story is that you'll find the same products and services, the same technology, the same lending options that will help you out in creating the best financial security for yourself. So we offer mortgages, low rate auto loans, credit cards, home equity, lines of credit, and personal lines of credit. One of the great things that we've done this year is we've partnered with at UCLA Alumni to offer our Bruin Edge and Bruin Choice Visa cards. For those of you who are very new to this program, the Bruin Choice is for UCLA students. The Bruin Edge is for those who have already graduated from UCLA or have more established credit with in the financial sector. So there's a list of highlights that you can see where you get a 0% APR intro for 6 months, 50,000 points after $2,500 spent within the first 3 months, 1.5 points per $1, and 5 points per $1 at all these various UCLA affiliated outlets. That includes the Rose Bowl Stadium, the Brookside Golf and Restaurant at the Rose Bowl, Poly Pavilion, and various ASUCLA campus restaurants and dinings on campus, and obviously athletic events as well. We also offer insurance services: auto, homeowners, renters, health, dental, disability, protection, life. I know I'm going through this really fast, but I want to get to our featured speakers. And then the last sort of benefit that we have by doing business with UCLA is we want to remind you that Wescom is more than just a credit union, more than a financial institution. When you become a member with Wescom, you'll be associating with an organization that emphasizes building better communities. So we are very on the forefront with helping out and supporting a lot of initiatives that are important to the UCLA community, including supporting organizations such as the CPO Food Closet, Student for Students, the Los Angeles Regional Food Bank, and Second Harvest Food Bank as well. One of your featured speakers tonight is Carl Gerstenacher, who is a UCLA alumnus. He's your investment advisor, and he's exclusive to the UCLA audience. So when you're done listening to what Carl and David Jabzinski has to say this evening, make an appointment with Carl, and go over some your portfolio, or if you want some investment advice or financial advice, Carl is the person to help you out. His contact information is listed on the screen. As I mentioned, we have 24 Southern California branches located throughout Southern California. Operating hours are Monday through Friday, 9 a.m. to 6 p.m., Saturday, 10 a.m. to 5 p.m. We want to encourage all of you to participate in tonight's conversation. So participate either via the chat or participate at the Q&A session towards the end, and you'll have an opportunity to enter to win for a $50 UCLA store gift card. You can always contact us at any time at ucla.wescom.org, or you can also reach out to us on the telephone at 888-493-7266. I want to thank you for tuning in and listening to my little overview of Wescom. But now I'm going to stop sharing my screen, and I'm going to send you over to our featured presenters this evening. We have Carl Gerstenacher, who I mentioned already, who's your financial advisor with Wescom, and he's the exclusive advisor for the UCLA audience. And David Jabzinski, the Director of Investment Services with Wescom. They're here to give you a great presentation. I hope you enjoy. Have a good evening. And Carl, DJ, take it away.
All right. Well, good evening, everyone. I'm David Jabzinski with Wescom Financial Services. As Sal did mention, I'm the Director of Investment Services for our program. So I do oversee our investment advisors in our 24 offices, and we have 18 individuals that are helping and serving our members each and every day. Hope you enjoy the presentation. We are definitely going to be covering a lot of topics as it relates to retirement, as it relates to investments, and talk a little bit about Social Security, long-term care, even touch on some different types of investments and tax-deferred and tax-free accounts. So let's get to our first couple of slides here. And again, we're going to probably take about the next 30 minutes or so. Please ask questions. That's what makes this important and interactive. Love to hear from all of you. But just a couple of quick overview about Carl and I. As Sal did mention, again, we're with Wescom Financial Services, and we provide great guidance and insight to our members as they come in and work with us. We currently are managing about $1.5 billion for our members at Wescom, and that represents about 14,000 individuals that we work with on a day in and day out basis. So over the next 30 minutes that we spend with you, Carl and I will each take some of the slides that we have in front. And again, we wanted just to talk about retirement and give you some great nuggets of information to take away. All the information, of course, can be provided to you after the event, such as the slides, and we do have a couple of handouts that we can email out. So without further ado, I'm going to go ahead and introduce Carl Gerstenacher. Carl is, as Sal said, our dedicated advisor for UCLA. He's also a UCLA grad, so just excited to have him here tonight, and he's going to kick us off with our first slide. So Carl, I'll turn it to you.
Hey, DJ, thank you. Good evening, everybody. Thank you so much for taking some time out of your evening to spend with us. Hopefully hopefully everybody finds the information that we share useful, beneficial, and hoping that everybody learns a little something that you can apply towards planning towards retirement, whether that's much down the road for you, if it's something that is around the corner, or if it's something that you're currently in, right? So very glad to be with you guys. Again, I'm Carl Gerstenacher. I'm the financial advisor that covers the UCLA as well as the Culver City branches for Wescom. And so I typically sit with members and with clients, and overall what I do is I help folks make informed financial decisions. And so what that usually entails is talking about financial planning and investment strategies that you can apply for some long-term growth. So today we're going to be focusing on retirement, right? And again, like DJ said, we're going to be covering a wide range of topics and kind of general information. Again, if you find some of this information useful and you'd like to talk maybe a little bit more specifically about your situation, then feel free to reach out. We'll provide you guys with contact information at the end. But let's jump in here. So again, the topic that we're covering today is retirement, right? So oftentimes when I'm sitting with members and with clients, a big conversation to talk about is what does that look like for you, right? Is retirement partial retirement, where folks decide to maybe slow down on working but continue to work part-time? Is it more, not working at all anymore and just spending more time with family? Is it traveling? Is it starting a business? Or is it buying a property? What exactly might that look like for different individuals? Because essentially at the end of the day, what we're trying to do is turn any sort of assets or savings that folks have accumulated over time into maybe income that's going to be useful when you do transition into retirement, right? And a big part of that is what your objective is when you are in retirement. So we'll hop into this next slide here, DJ, if we can go. Three main, let's say, factors or things that we're going to be covering today throughout the presentation that are key, we think, to funding a comfortable retirement. Number one is determining your personal needs, right? So what might your monthly expenses, your personal needs might be when you transition into retirement. Again, that has a lot to do with the lifestyle that you're looking to live retirement in. Number two is developing an actual investment strategy that's going to get you there, right? Either saving or investing a certain way to have those assets grow over time so we can get to a particular goal while in retirement. Then a big thing that is a big conversation is obviously number three, protecting that nest egg, right? So once we have developed it and grown that nest egg, how do we protect it now that you're retired and likely going to be using some of those funds that you've saved for so long? So we're going to be covering those things today. A few little bit more specific items that we want to factor in when it comes to your personal retirement income needs, right? So your retirement age, right? So at what age do we anticipate retiring, right? It's a different need for folks that decide to retire maybe closer to 60 versus somebody that maybe decides to retire closer to 70, right? When you work a little bit longer, and we'll cover that in a second, you're able to save more, and so you'll have more assets for retirement. But sometimes folks decide to retire earlier, and so we have to figure out how to make current savings last throughout the retirement. That kind of goes along with length of retirement, right? Healthcare needs. So everybody's health situation might be a little bit different. And so healthcare costs, as everybody knows, are something to be concerned about in retirement, especially maybe before 65, 65 being a key age when we start Medicare, right? We'll touch on that. A hot topic that I think everybody's seen, if you turn on the news at all or read any sort of news, inflation, right? The talk of inflation, the cost of everything around us increasing over time. We're seeing a big increase in inflation this last year. Planning and saving and investing for retirement, our goal is to try to at least keep up or beat inflation, because that is a factor that comes into play over time, right? Then obviously your lifestyle, right? So what type of income will you need to support a certain lifestyle that you'd like to live during retirement? So we'll jump in here. So retirement age, like I mentioned, a key factor to consider. So like I mentioned, the earlier that you retire, the shorter period of time that you have to accumulate funds, right? And also the longer that you're going to need those funds to last. As we'll see in a couple of slides, we're all living a little bit longer now than before. Has to do with technological advances in healthcare, right? So we are living longer. A key thing to remember is that, you know, for a lot of Americans, we depend on Social Security as part of our income. A key thing there is that it was never designed to be the main source of income, but it was designed to support us in retirement as part of our income. So we got to keep in mind that that doesn't begin, or we cannot start that until 62, right? And so retiring early might play a little bit different for somebody who decides to retire before 62. And then obviously we talked about Medicare, right? Healthcare costs. We normally get our health insurance through our employer, a lot of us. And so, you know, that changes at 65 if we decide to retire about that time. So retirement age is a key thing to think about. Just a quick graph that shows a survey was taken in which the folks that participated were asked, you know, at what age range do you believe you're going to be retiring at? And basically what this chart shows is that a lot of folks weren't exactly sure when they were going to retire. They planned retiring after 66, probably because that's when a lot of folks is full retirement age for Social Security purposes is after 66 for a lot of Americans. So you can see a lot of folks just, were expecting to retire after 66. However, the green bars you see there indicate that, you know, a good portion of those same folks actually retire earlier than that, right? So the planning is a big part of how you're going to live in retirement and the amount of income that you'll be able to generate from your assets and your savings. Another chart that shows you know, kind of life expectancy in terms of how long your retirement's going to be, right? Like I mentioned earlier, we're all living longer, right? So when we're living longer, we have to take under consideration that assets that we save, right? Money that we save, investments that we have, whether they're retirement accounts at work or outside of work, those assets need to last. Again, just how the data shows that it has to last longer now than it did before, simply because we're living longer, right? Again, this chart here just shows that on average, a 65-year-old, a healthy individual may expect to have a 20-year long retirement. Key thing there is that if this individual is fully retired, those savings, those investments need to last throughout the retirement to ensure that, you know, we don't have to worry about running out of funds. And again, here, healthcare costs, right? Healthcare costs being a big concern as we age, as we get older. We can see here that in healthcare, you know, in insurance premiums, things like that, the cost has actually, over the last 3 out of the last 4 years, the cost of healthcare has actually outpaced inflation, right? This obviously doesn't have, you know, 2021, 2022 on it, which inflation was, you know, much higher this last year. However, this shows the 4 years before that, and we can see that healthcare costs, you know, again, 3 out of the 4 years has outpaced the just regular inflation rate that we see in the general economy. So again, something to consider, especially as we age and the likelihood of us needing more care or you know, the cost in general of healthcare increasing. Something to take under consideration when we're saving and when we're investing for down the road. And again, inflation being a hot topic here the last couple of months, or the last year, I should say. This shows inflation at an assumed rate of 3% per year over the last 20 years, right? Obviously, this last year is a little bit different. We haven't seen inflation increase year over year the way it has this past years for the last, you know, since about 1982. So it's been a long time since it increased that dramatically. However, that just illustrates the importance of, I believe, putting money away, investing it, and growing it over time, simply because the cost of things, as you can see here, right? The cost of a new car, this last year is very indicative of how inflation has really played a role in that particular industry, right? So again, cost of things increasing every year. We want to make sure that we're saving and we're putting money away to build that nest egg so we can have assets to pay for this stuff down the road. DJ, I'll turn it over back to you.
Okay, great. And real quickly on inflation, very interesting. I know a lot of folks probably see some of the headlines that are coming out right now about potential for rate increases. Something interesting, and again, things continue to keep developing every day. If we go back, let's say 5 or 6 months ago, they were predicting the Federal Reserve would actually raise rates one time. Fast forward to last week, they're saying potentially 5 potential rate increases to try to calm this inflation. We all experience and feeling it right now. And what's interesting is the discussion this week is not only, of course, potential for 5 increases, but now they're talking about will these increases be front loaded, meaning that instead of just 1/4%, could it be 0.5% or even 3/4%? So more to come on that, but very, very interesting time as it relates to inflation. So just going to move to this next slide here and take the next 7 or 8 slides and cover with everyone. So talking about lifestyle and talking about retirement. So when we sit down with individuals, they're always asking us, so what do I need and how much do I actually need for a comfortable retirement? Now, could that be 70%? Is it have to be close to 100% of pre-retirement income? It all depends, right? And Carl said this at the very beginning. Very important to understand, what does that lifestyle look like in retirement? Is that going to be still working, maybe a hobby, maybe a part-time or a home business? It could be a lot of different things. So again, that's kind of where that planning comes in, just to determine what does that look like from a pre-retirement standpoint. Now, one of the things that we always discuss, and this is as it relates to retirement, is just want everyone to think about a 3-legged stool. So each one of those legs represents a leg that you actually are going to access from an income standpoint in retirement. You can see on the screen here, it talks about Social Security. That second leg could be continued employment, but you may be saying, you know what, I don't want to work. And so that second leg could be potentially a pension, or it could be some sort of retirement plan that was set up through your employer. And then the third leg is typically personal savings and investments, and that could be qualified accounts, tax deferred accounts, things such as that. So looking at each of these legs, I think, is really important. And so what I'm going to do on the next slide is talk about the one that I think everyone talks about when they sit down and do retirement planning, and that's Social Security. So the first thing I would tell you about Social Security, and I think everyone has hopefully done this, but probably the most important thing that we can all do is get signed up on myaccount.com. So Social Security has a web page. It's actually right here. It's ssa.gov/myaccount. So it's a great way just to get signed on. And in fact, I have my statement in front of me as I'm looking at it. What's interesting is it's 2 pages. I think some of you may recall in years past that Social Security would just automatically send this out. Well, now you actually have to go into the system, get logged in, which is a great way to do it. And you're going to see a lot of information. You're going to talk about, what your benefits look like if you retire at, let's say, 62, or you push that out to age 70. So it's going to give you a dollar amount. It's also going to give you some interesting statistics. I thought this was always interesting when I look at this. From the first day you've started to earn income up until when you print this and pull this information, it's going to tell you how much you've actually paid in Social Security tax, as well as your employer. So depending on that first job all the way up through your current position, it's going to show you what that looks like, both for Social Security and, as Carl said, Medicare. So, Social Security is what they're saying is really like a 30 to 40% replacement of income. So again, it's one of the 3 legs. And so it's really important to make sure that the other 2 legs, that we spend time talking through that and spend time building a plan there. Also, a number that's on the screen here, the average individual's retirement benefit through Social Security, it's about $1,500. So thinking about what that lifestyle looks like, if it's, I really need to get to 5,000 or 6,000 a month, if that's that monthly number, then that's where, looking at some alternatives is a good idea. Now, one of those alternatives that everyone always brings up to us is says, you know what, okay, DJ, I'm going to go ahead and take Social Security. I'll probably have a part-time job, or even work on maybe a home business or a part-time business that I've always wanted to, kind of do. And that's absolutely a possibility. So kind of some interesting statistics here that's from the Employee Benefit Research Institute. So they're saying that 74%, so that's a good chunk. That's about 3/4 of all the workers are saying, you know what, when I get to that age of retirement, I probably will continue to work. the reality becomes about 27% of retirees say they're actually going to have worked in retirement to pay for retirement. So again, we just want to make certain to help plan for that, again, that three-legged stool, the other parts of the retirement income stream that can actually help. Now, one of those streams we talked about is personal savings and investments. So this would be bank accounts, IRAs, savings accounts, things you have at the credit union, or even a national bank. You know, again, these could be tax-deferred IRAs. It could be annuities. You could have a stock portfolio, mutual funds, ETFs. These all will contribute to providing some sort of income. In fact, as we work with our members today, one of the numbers that we kind of put out there for, you know, deciding, okay, how much should I be taking from my personal savings and investment in retirement? And that number really is around 4%. That's a good number to kind of use from a personal savings and investment standpoint as far as the income stream that will be coming off those accounts. Now, looking at the different accounts, I love this chart because it just talks about the power of compounding and tax deferral. So you may have some accounts that are your personal savings and investment accounts. So think of those accounts, and this chart shows a pretty interesting example here. So let's say we took $10,000, we put it in one account that actually you would pay tax on, and the other $10,000, let's say that was in your 457 or 401k or 403b, some sort of employer tax deferred program. No surprise here that the account that, of course, doesn't pay tax is going to grow faster. That could be a tax-deferred annuity. That could be a 401k. So the whole conversation here is that you do have the power of compounding to grow your account quicker. And that's really what we're saying here is, you know, look at some of those personal savings and investment accounts. And is there a way to take some of those accounts and maybe make them tax-deferred or even tax-free? And I'm going to show you a couple of examples in just a second. Now, we all may have seen or know our numbers for how much we can put into a retirement plan. Now, keep in mind, this is 2021. So again, for 2022, this shows you how much can I put into a company or a employer-sponsored plan. So traditional 401ks, 403bs, 457s, again, just looking at what that annual contribution amount is, it was $19,500. That now is $20,500. And then once you reach age 50 or more, the IRS says, you know what, we're going to allow you to put an additional $6,500 to catch up, to make up potentially for the earnings and everything that maybe you didn't have an opportunity to put in at a younger age, but now based on where you're at in your income, you have the ability to do that catch up. So again, great way to just defer money into this account. And then hopefully there's some sort of employer match, which is in addition to this, which helps, again, get to that end result much quicker. I mentioned, let's talk about a couple of accounts that you may want to consider. And these are accounts that you would do outside of your 401k or 457 or 403b. So again, there is some limitations as far as who can contribute, but you may have heard of a Roth contribution. So a Roth account is basically a IRA, but it has special tax privileges. So you're going to put money in here that's after tax contributions. It's going to grow tax deferred until you withdraw it. There's a couple limitations that you have to be aware of. There is a holding requirement of 5 years, and you must reach 59 and a half to be a part of this. And again, it's non-qualified. So basically, you're putting money in here that you've already paid tax on, but the hope is that you're going to grow this and basically get this account to a point where when you take the money out, it'll be tax-free. And I have another slide to show you in just a second. But in addition to the Roth, there's the traditional IRA. This has been around for many years. So again, most employers do have a retirement plan, and that's great. If you have a retirement plan, or even if you don't have a retirement plan, depending on your eligibility, you could potentially fund both your 401k or 457 and the traditional IRA. Again, there is some restrictions, and you just want to take a look at that before you make the contribution. But a traditional IRA works very similar in the sense of how it's always worked. Money goes in here, and it's tax deductible. So that money goes in, and that's a direct tax deduction to you. It's going to defer, and then, of course, when the money comes out, it will be subject to taxation. Now, the hope is at retirement, you're in a lower tax bracket, and of course, you're going to pay less in taxes. Now, we talked about the Roth, and I just wanted to mention a couple of things that, again, are real interesting on this, and I'll kind of close on this and turn it back to Carl. But again, it's after-tax contributions. It grows tax deferred, and the withdrawals are tax-free. So kind of interesting. Something that's been talked about now is individuals that have maybe children or grandchildren that are starting to get into the workforce, 18, 19, 20, 22 years old. And what kind of account should they look at? Well, the Roth IRA is a great account if you start young, because think about it. If I can put contributions in here, they're going to grow tax deferred. I can pull them out tax free. What a great opportunity. We even hear now individuals and families that are saying, you know what, can I hire my children and actually pay them through my company or through my business, and then they can make Roth IRA contributions. So it's a lot of ways to utilize Roth IRA accounts, and they're very powerful if you start early. And again, there is requirements to qualify for the Roth IRA, and that's where sitting down with someone like Carl and Wescom, we can actually help you determine if that's appropriate for you. So Carl, I'll turn it over to you for the next topic, which is annuities.
Thanks, DJ. There was actually a couple of questions that we had in the chat box if we want to jump in on here. So you see, Eileen, thanks for the question. Can we discuss the windfall elimination provision as it relates to Social Security due to working at UCLA? Yeah, so essentially what the windfall elimination provision is, it's essentially a formula in which it impacts folks that have maybe a pension or an annuitized pension, which we call it, pretty much monthly income coming in which your Social Security may be affected if no contributions were made to the Social Security bucket, let's call it, right? So normally in let's say if you work for a private company, every time you get paid, then a part of your pay goes to taxes and to funding Social Security. Now at UCLA, in terms of how you're impacted for your Social Security benefit when you retire, I think that depends. Every situation is going to be a little bit different. By law, your Social Security benefit, if you've contributed to it, this provision, the windfall elimination provision, they can't withhold all of your Social Security if you're supposed to receive it. The most that can be withheld if your pension, after a calculation, they deem it as too high, then up to half of your Social Security at most can be withheld. Again, that's a very situational, individual situational item that we'd want to look at. On the Social Security website, there's a pretty neat calculator on there that you could input your own personal data and information and kind of see how you would be impacted in terms of your Social Security benefit. I've worked with UCLA members or UCLA faculty or former UCLA faculty where they weren't affected at all, right? So they received their full pension amount as well as their full Social Security benefit. So again, it depends, Eileen. And again, if you want to chat maybe offline, we can look at your specific situation and see what that looks like. Hopefully that answers your question.
And Carl, just to add to that, there's actually a great resource on that site. I'll go ahead and put in the chat box. You can go directly to the SSA site, and they have kind of another link within there that talks about the windfall. So I'll put that in the chat box for folks to click on.
Very cool. Thanks, DJ. Another question that came in, Jim. Jim asks, can I contribute money to my IRA after I retire? Meaning taking money out of my taxable account and moving it to my IRA. Good question, Jim. So contributing to an IRA or a Roth IRA, so a traditional IRA or a Roth IRA, the IRS does say that you have to produce income from wages in order to contribute to an IRA. Or if your spouse is, let's say you retire and your spouse is still working, then that would also qualify you to be able to contribute to your IRA. But once, let's say in a hypothetical situation, somebody retires fully and isn't working anymore at all, then at that point, we're unable to contribute to an IRA if there's no income coming in from wages, or if your spouse isn't generating income as well. DJ, anything you wanted to add to that one?
No, I think you did a great job explaining that. Yeah, absolutely. It is earned income. And you know, it's interesting. I know we do have access to different calculators that we can actually go through and determine based on income, how much in earnings. But again, that would be the case.
Okay. Okay. There's a couple other questions here that we could cover now or later on. What do you think? How do you factor? So
yeah, we have about another 10 minutes before we need to wrap up. So
okay.
Absolutely, this is important to cover these questions.
Okay, got it. So Sarah, thanks for how do you factor the value of your home as a potential asset for retirement? This seems to vary quite a bit. Good question. So the your home essentially is an actual asset, right? Typically, in most cases, an appreciating asset. The main thing I talk to members about and to clients about is the expenses that come along with home ownership, right? So if there's a mortgage on the home, a monthly payment that you're still paying to pay off the mortgage, that's a big factor when it comes to monthly expenses and maybe how much retirement assets, how much retirement savings you have to pay for that, if it's still doable, and seeing how long you have until that home will be paid off, right? If the home is paid off, that's a great thing, right? That's an awesome thing. No monthly expense when it comes to a mortgage. Obviously, property taxes are still a factor, but definitely reduces your monthly expenses when you're transitioning into retirement if you don't have a mortgage or rent. But your home is essentially an asset. But the important thing, I think, when looking at that when it comes to monthly expenses is whether there's still a mortgage when you're transitioning into retirement, because that plays a big role in terms of how much money you'll need to be pulling from retirement accounts. Let's get here. So I think, Robert, you had a question here regarding the $270,000 a 65-year-old couple will pay for healthcare. What will that cover? Health insurance, copays? Good question, Robert. I mean, that's pretty much, you covered most of them. A combination of all that, right? There's situations where copays, deductibles, right? Premiums for healthcare, depending on the type of plan that you receive. Nursing home care, long-term care, items like that. I believe I read a stat that an average 65-year-old male has about a 70% chance of receiving some sort of nursing care throughout the retirement. Now, that doesn't mean you live in a nursing home facility. It just means that some sort of care or assistance is needed during your retirement at some point. That's where larger costs come into play also. So pretty much, Robert, everything you mentioned in your question there, all that comes into play when it comes to the expenses that you see when you start to transition into retirement when it comes to healthcare, right? And more often, because we're aging, we'll likely need care more often than when we're younger and working. So that's where the expenses increase. Ron, I see your question. Has anything replaced stretch Iras? That's a good question. It's a very detailed and, again, not complex, but there's a lot of details that came into play in January of 2020 when it comes to these with stretch Iras. I'll cover these kind of on a high level. If we need to dive in a little bit more, we can talk offline. But in January of 2020, Congress changed the rules when it comes to folks inheriting IRAs, right? So if you are a spouse of somebody who passes and you inherit that IRA, pretty simple. Oftentimes you just take over as the owner of that IRA. However, if you're a non-spouse beneficiary, so son, daughter, cousin, non-spouse, there's a couple of very specific rules that apply now. For most folks, the stretch IRA is no longer exists. If you are a non-spouse beneficiary who is more than 10 years younger than the person who passed away, then that stretch IRA is not an option. Essentially you have 10 years to make sure that money in that IRA is liquidated, right? So before, it used to be the case that it didn't matter how old you were as a beneficiary, you could stretch the IRA throughout your lifetime, the inherited IRA. Now that rule changed depending on age. And so very specific, I'd be happy to Ron, to cover more in detail if you like after the call, but Essentially, the stretch IRA it still exists, but for beneficiaries of an IRA that fit a specific description, let's say, in terms of age. Long-term care, Elaine, thanks for the question. Do you have any recommendations about long-term care insurance? Specific recommendations, we can talk offline about your specific situation, because it all really, I hate to say it's Elaine, but it all depends, right? It all depends on everybody's situation in terms of whether traditional long-term care insurance makes sense, or if there's other long-term care type of products, let's call them, that are out there that are more of a hybrid, where they allow you more flexibility. So again, something we can discuss in more detail in terms of a recommendation offline. And so we got a couple questions here, guys. So we're going to move on with the presentation, if that's okay. And we'll come back to the questions just to get through. I know we don't have that much time left, so I'll kind of go through these as efficiently as possible and talk about these slides and these investment types. Annuities, which is what you see here on the screen, these are essentially what an annuity is. It's essentially an investment type that provides contractual guarantees, right? Most annuities for investment purposes, these are the three type of annuities that folks use for investment purposes, right? To grow your money over time. And so annuities essentially are tax deferred contractual investments where you have to leave your money in there for a certain amount of time, right? To avoid penalties. And so a fixed annuity provides a fixed interest rate while your money is in the annuity. A variable annuity, kind of what it sounds like, it's an investment type where your money is shielded from taxes and it grows tax deferred, similar to like how a 401k would, or a 403b. And then when you go to withdraw your money in the future, your gains are taxed, right? Whatever interest you made. A variable annuity means that it may fluctuate in value, right? So it has some sort of exposure to the stock market, to the bond market, so it can fluctuate, but over time can grow well if you have good investment in there. An index annuity is a investment type that is, again, we have to leave it in there for a certain amount of years. It provides you safety of principal, but it gives you modest growth potential by following the performance of a stock market index and participating in some of its growth, but also protecting you if it were to go down, right? So it provides safety of principal. So we'll go on to this next slide here, DJ. Again, other types of investments that you can utilize towards saving when it comes to investments. Most of you, if you've had exposure to 401ks, 403bs, any sort of retirement account through your employer where you've invested, you've had exposure to mutual funds, right? Mutual funds or index funds, ETFs or exchange traded funds. These are investment types that the very simple way that I define them is they're like baskets, right? They're investment types that are like baskets that hold many, many stocks, many, many bonds, or both inside of them, right? The more aggressive mutual funds are ones that have stocks in them. They're going to fluctuate more, but they're also going to grow more over time. And the other mutual funds that are maybe more conservative, lower risk, but maybe don't return as much, they're going to have bonds inside of them, right? Again, very common investment types that we use inside of our retirement accounts. You could also invest in those outside of your retirement accounts as well. DJ, if you like, we can skip this. This is pretty much talking about,
Sure.
Running a budget, right? Kind of seeing before transitioning into retirement, what your expenses look like. Very important to do before starting to transition there, even beforehand, even if you're years away from retirement, just to understand what your potential expenses might look like. We're going to jump into a specific, or a little bit more specific when it comes to developing some sort of investment strategy and what that means. We'll cover diversification and asset allocation. Those two items are very similar. It's just if you want to jump to the next slide, DJ, it's just the idea of investing in different type of vehicles, right? Investment vehicles that can grow well, and sometimes that you might have other investments that maybe perform not as well, but by diversifying, you give yourself, you limit risk by still trying to increase the value of your investments, right? So diversification allows for things like that. Again, right here, it just shows that in a specific situation, right? If somebody had $200,000 and you invested it for 25 years, right? Diversifying it allows you to have different type of growth in different investment types, right? And that's kind of what we're hoping for. Diversification comes into play a lot in specific age bands, right? What I mean by that is, the younger that somebody is, the more aggressive somebody can be, simply because, especially with a retirement account, simply because somebody who's 25 years old likely isn't going to need that money for 35 years, so they can afford to take higher risk to try to grow that account as much as possible. That portfolio might look different for somebody who's 65 transitioning into retirement, where the idea is not so much to try to hit a home run with investment, it's more so to preserve, still keep up with inflation, but to preserve the value of those investments and grow them modestly over time. Because at that point, when you're getting close to retirement, we may need to use those funds.
Hey, Carl, so we have 2 minutes here. So maybe we find a slide or two to take a look at and
Sure.
provide some closing thoughts. And then maybe what we can do as our next presenter is up, we can answer some of the questions in the chat box for everyone.
Got it. Sounds good. Yeah, feel free, DJ, if you want to hop over to the 30-second slide just to kind of go through it. This guy just shows kind of what a conservative asset allocation looks like, right? The idea here is the more stock exposure you have, the more aggressive your account is. Go ahead, DJ.
Yeah, and real quickly, I know we're at the end of our segment here. Couple of things that we wanted to do. We want to make sure that all of you have some good resources from us. And so what it shows here is how much risk can you actually stand? It's very important to go through a risk tolerance questionnaire. We do have access to this and we can send that over for distribution. But again, it's important to just understand if the market goes up, if it goes down, how would you react in those situations? So it allows us to get a risk tolerance and determine what's a good risk score, showing some of the different conservative or moderate or even aggressive investment stances. And then just a couple of other quick slides here. Let me just kind of use this as maybe one of our last slides. As Carl did mention, we talked a little bit in the beginning about some of the different returns some of our investments can produce, whether it's treasuries or corporate bonds or stocks. Just trying to find what that right allocation, I think, is very important. We've seen bonds do well for many, many years because rates have gone down. We're now seeing headwinds in the bond market because rates are actually going up. And so when rates go up, it pushes your principal down. It's that seesaw effect on your principal. And of course, sometimes when rates go up, it does have a negative impact on some stocks, not all stocks. We've seen oil and financial services, utilities, and some of these commodities actually do well because of some of the headwinds that have been happening, such as higher rates, conflict internationally. We're still coming out of this pandemic. So just understanding what that right balance is very, very important, because that definitely can enhance your returns as you go forward. And the team at Wescom, we are absolutely here to help you and navigate through this. So we're all about providing a lot of financial education, financial literacy. So feel free to reach out to us. And again, we appreciate the time this evening. And I will now turn it back to Sal.
DJ, Carl, thank you for a lot of that information. Again, we're going to do a Q&A at the conclusion of the program. So please hang in tight. We're going to address some of the questions directly in the chat box, as DJ mentioned. But before as we move forward, I'd like to introduce Irvin Rodriguez, who's with UCLA Gift and Planning. Irvin, he's got some information to share with all of you this evening. So Irvin, take it away.
Thank you so much. Hi, everybody. My name is Irvin Rodriguez, and I work in the UCLA Office of Gift Planning. And I'm going to be sharing a little bit of information on what we do in the Office of Gift Planning at UCLA. When it comes to gift planning, the main question is, what is it? When it comes to what planned gifts are, it's a tool that allows donors to achieve their philanthropic goals while maximizing tax and income benefits. So when somebody reaches retirement age and they're starting to look at their assets and what they have accumulated during their lifetime, at that time, they typically start looking at what they might need when it comes to potential tax benefits, as well as how they would like to make an impact at the university or through other charitable means as well. So this program enables donors to make larger gifts, but also diversify their assets, and it allows us to have a discussion about what they would like their legacy to be at UCLA. So I'm going to go ahead and move on and discuss a couple of the various gifts that we offer within the Office of Gift Planning. And so, as I mentioned, some of the benefits here are, donors who have accumulated a lot of income, a lot of securities during their lifetime, and they have low cost basis. They might have a situation where they might trigger additional taxes if they were to sell those securities themselves. They might have a lot of their assets in one portfolio specifically, so they might want to diversify. So this allows us to do that as well. They might want to increase their income during retirement. They might want to increase the inheritance to their heirs. So as Carl mentioned earlier, there's issues when it comes to donors who have Iras that they want to potentially leave to a child or someone who is not a spouse that might present challenges. So that's where our office can assist with that as well. And we have different ways of making things that are not liquid in order to produce a income stream for a donor, as well as to, again, help them achieve their philanthropic goals. So I'm going to go ahead and talk about some of the plan gifts. So the main plan gift, and it's the easiest type of plan gift that a donor can make, is a bequest. So that is simply, gifting something to the university through their will or living trust. This can be something as simple as a retirement plan, as well as somebody's personal tangible asset like a home or paintings, coins collections. So at the end of the day, UCLA is able to administer the distribution of some sort of an asset to the university that we can then apply to donors' philanthropic goals. So if somebody was really passionate about, let's say, establishing a scholarship, but that's not something that they can do right now during their lifetime because they don't feel comfortable parting with those funds, it's something that we can assist them by providing them with the language that they would need to insert into their will or living trust. We talked about annuities a little bit before, but we do have something called a charitable gift annuity at UCLA. So it works pretty much like a commercial annuity, but there are some key benefits with doing a charitable gift annuity. So a charitable gift annuity essentially allows the donor to make a donation to the university now, and then the university agrees to pay a percentage back of that fund or that principal funding amount for the rest of their lives. And it's backed up by the university's endowment. So essentially, it is a true annuity in the sense that it will never exhaust. And at the end of the contract, so when the donor passes away, then what remains in that contract ultimately goes to fulfilling the donor's philanthropic goal. And annuities can be established for one individual or two, and we can accept various assets to fund these annuities. So we can fund these annuities with cash, or again, if somebody has highly appreciated securities, let's say somebody bought Apple stock in 1990, now it's appreciated a lot and they don't want to necessarily sell it themselves because of the capital gains it might trigger, you can fund that. You can use those securities to fund an annuity. We also have a different flavor of that called a deferred gift annuity. And this essentially what it means is that it allows donors who are not within our age parameters necessarily to go ahead and establish one now. So our minimum funding age for a charitable gift annuity is 65. So we do have donors who inquire who are relatively younger than that. They might be 55, 50 years old, but they're looking in the long term as to what they might need in retirement. So they'll decide to go ahead and establish a deferred charitable gift annuity in their late 50s, mid 50s. And what this essentially allows us to do is they will defer that payment. So they will not receive it as soon as they establish the contract. And then we elect a triggering year. So let's say when they turn 65 or turn 68, where they then activate that income source and start receiving that income for life. And then one of the other plans that we offer is a charitable remainder unit trust. So this charitable remainder unit trust works a little bit different than a gift annuity because it's not a fixed dollar amount. So donors the donor and the university will work to agree on a percentage that we pay the donor for the rest of their lives based on the value of the trust. So essentially the donor funds the trust with a donation. Once the trust is established, and the university will invest the funds within the trust, and we agreed to pay the donor a fixed percentage of the value of the trust at the beginning of every year. And these trusts can be funded with various assets. So as I mentioned, the simplest asset somebody can use is cash, securities as well. But we also have donors who might want to set up one of these vehicles through, let's say, the sale of an apartment complex. So an example that happens frequently is somebody has a rental property that they no longer want to manage it well into retirement. So instead, of selling themselves and having to pay, any capital gains, potentially because they bought this apartment complex with a very low cost basis, they will donate it to the university to establish one of these charitable remainder unit trusts. And the trust itself will capture all that capital gain within the trust itself. So they will then generate an income stream for life without having the huge tax burden that selling it themselves might have triggered. And then one of the other key vehicles that we use to assist donors is what we call the retained life estate. So I saw one of these questions come up in the chat, and essentially what this is somebody might own a home, and that might be their primary asset, and they're not receiving enough income from other sources or other investments that they make throughout their lifetime. So what this allows us to do is essentially, it works very similarly to a reverse mortgage. So the donor and the university agree or come into an agreement where the university will take possession of the home when the donor passes away, and we will sell the home, and then from what we receive from those sale proceeds, we will then apply to the donor's philanthropic purpose. During the donor's lifetime, however, we are able to establish as I mentioned, what we call the retained life estate with a gift annuity. So we will give the donor a gift annuity for the rest of their lives, and they will be able to continue living in the home until they're no longer here. And then at the point when they pass away is when UCLA is able to then take the home, sell it, and then from there we'll fund the donor's philanthropic goal. With any planned gifts, it really is specialized and modeled for each individual donor. Each individual donor has a very specific case. So as you continue moving forward with your investments and learning more about retirement, what you might be interested in, please feel free to reach out, and I'm happy to provide any additional information or personalized gift illustrations on some of these vehicles that might work for you. We have a couple more that I'm not going to get into because we've run out of time, but feel free to give me a call or email. Here is my contact information. So again, the UCLA Office of Gift Planning deals with donations to the university and also with helping donors maximize their income and philanthropic goals when they're either preparing for retirement or once they have retired. So thank you so much for your time.
Irvin, thank you so much for that great information. And of course, just wanted to say that, all of this information tonight is very valuable to everyone. And that, this is something that we're all learning, and it's great. We still have time for our Q&A session. And DJ, Carl, how are we doing on questions? Have we addressed a lot of the questions in the chat? Or are we still looking at discussing some of them right now?
It looks like there's a lot of questions in the chat. Depends on
there is
depends on time.
Yeah, would you like me to go through them and help you guys facilitate these questions?
Sure, yeah. So I believe where do we leave off? So
we're at the long-term care one. So the next one, I'm more than glad to take this one. Do you or your estate get your annuity principal back at some point? So good question. Carl talked a little bit about the different types of annuities. There is fixed index. There also is a variable annuity. So it depends on which program that you're actually in. It's interesting, a lot of folks use annuities, and Erwin just talked about this too, as remainders, right? Remainder trusts, and you can name a lot of different individuals. So if you don't have an estate plan set up, a lot of times you can use these vehicles as tools to name a beneficiary, or let's say it's a primary or a secondary individual. But again, it depends on the type of annuity program that you're in. If you have an existing annuity, we're more than glad to just take a look at it. Some do come with a principal return, and it all depends, again, on the program. There is some that in the event of death, it would go to a beneficiary. And again, it depends on which program you're in. Some also waive fees and penalties. So again, important to take a look at the actual contract that was issued at the time the policy was issued.
Thanks for that, DJ.
Yeah,
sorry, Carl. I just wanted to, I wanted to address this question from Irma. I don't know if it's been addressed yet, but Irma asked, if I choose to have funds invested with Wescom, do you charge a service fee, and what percentage is it?
Good question, Irma. So meeting with folks that are interested in kind of looking at their personal financial situation, maybe running a financial plan, getting recommendations, there's no fee for that. So there's no service fee to sit with us and discuss that. Fees would come into play depending on the investment type, right? So on the account type, the type of investments that you decide to go with. Some investment types don't have any fees. some of them do. So it just depends on the route that we would take. But overall, to meet and discuss and to look at your situation and give recommendations and advice, there's no service fee for that. I think there was a few questions up above that we skipped. One of the ones that I saw is, can a spouse contribute to your IRA after they have fully contributed to theirs? I think Scott asked. Yes, you can contribute to your IRA if, let's say, you're not working but your spouse is. You're able to contribute to it, as long as the income threshold is met. And for folks that are under 50, you can contribute up to $6,000 into an IRA. If you're over 50 years old, you can contribute up to $7,000 as long as you made that much money in the year from work. And it's a little different with Roth IRAs. It gets a little bit more specific. Then your personal income comes into play in terms of whether you could contribute to a Roth IRA. If you and your spouse make too much money, I'd have to, it's slipping in my mind right now, the max amount of income before you're unable to. But there's a certain max where you're unable to contribute any more to a Roth IRA. Good question.
Thank you for that, Carl. Mm-hmm. Yeah, and thank you for that, Carl. And Brenda asked, and she asked for two kinds of scenarios. Brenda asked, are there scenarios where you might not want your house paid off, number one, and number two, what kind of strategy options might there be for affordable health care before one is eligible for Medicare? So one has to deal with paying off your house. The other one is talking about strategies before Medicare eligibility. Yeah.
I'd say, Brenda, again, a lot of these questions the answer will be, it depends. I personally think like paying off a property should be an ultimate goal if you own one, because it eliminates probably our largest expense, one of our largest expenses. And it allows more monthly cash flow, especially when you're transitioning into retirement. Some would argue that the tax benefits of having a mortgage might be beneficial, but again, that's a very specific scenario that you'd want to run with a CPA or with your accountant, right? If it makes sense to do that. Oftentimes, I would say paying off your house is probably a very solid way to go, because you have no more liability or debt on that asset, and it's fully yours, and you have just decreased your monthly expenses significantly. So. DJ, you want to take the other question was about affordable healthcare. Is that right, Sal?
Yeah, that's correct.
Yeah.
What kind of strategies and options are there for affordable healthcare before one is eligible for Medicare?
Sure. I would say you'd want to, but if you're retiring or if you're not going to have access to healthcare from an employer, prior to if you retire before 65, and that's something that is on your mind and an issue that you have to encounter, then I mean, depending on the state that you live in, I'm assuming most folks are in California. Each state has a marketplace that you can look into purchasing healthcare. If you're married, obviously you'd want to look into your spouses, right? Strategies and options. Well, I would say that's where kind of investing comes into play. Right. If you have retirement funds that you need to use maybe from the time that you retire to 65 to use to pay premiums for insurance, then then that's part of saving and part of investing to pay for that. I don't know if you have other things you'd like to contribute, DJ, to that.
One thing I'll say on the Medicare front, and again, once someone does qualify for Medicare and you're at that age of signing up for it, which is at 65, what's interesting is a lot of times individuals sign up for Medicare and don't realize that, on an annual basis, you can actually make a change to your policy. We have, a partner firm that we actually work with that helps with Medicare and, looking at these different options. And what's interesting as it relates to Medicare is, we have members that may say, hey, next year I need to change my doctor, my physician, or I'm looking for, eye care or hearing care and things like that. So that's really important to take a look at that. Once you're on your policy, there's an open enrollment period, which is of course October through December, but there's an opportunity to potentially change your Medicare plan. But before you do that, you want to make sure that you sit with a professional and understand, your physicians, your medicines, things like that before a change is made. So again, hopefully that answers that question there. And as Carl said, a lot of these I know real specific where we really would want to sit down with you and kind of have that discussion and say, okay, which is the best way for you to kind of progress down that road.
Thanks for that, DJ. We have a couple of really good questions here. One from Alan. Alan asks, are bonds reasonable investments given the ultra low interest rates and the growth of inflation? Is a 6.16% show in your risk tolerance slide realistic today?
Yeah, I'll take that.
Yeah, go ahead.
Yeah, I'll start and Carl, feel free to jump in. Yeah, what's interesting, I know in the charts that we show, for an example, I have this chart up on my screen still, and it's going back to 1996. So it's using historical data, and it's interesting if we actually graph the 10-year bond from 96 till now, you can see although that's the average, it's like a straight decline. It's like a 6% decline all the way to the past year. And so in the past year, we've actually seen rates starting to jump up. In fact, the 10-year is over 2% today. So again, 6.16 is definitely not realistic from a bond standpoint. Now, let me just clarify that from a government bond standpoint. Now, there is other ways to look at this. There's, of course, tax-free bonds, there's corporate bonds. But again, 6.6 is a pretty high number right now to look at. If you take a look at like the average returns of stocks, you're going to be closer to 9. And what's interesting, and this is what a lot of folks have been looking at, and this is why I think value is starting to do well this year, is some of these companies do pay nice dividends. So even though you're holding the company for appreciation, which is the ultimate goal, you're getting paid to wait through dividends along the way. And so that's a very attractive investment. So what's interesting, there's been, I guess, a lot of bond alternatives which people have been looking at, such as utilities that pay a pretty good interest rate. And of course, you may get some future growth. So there is some, I guess, alternatives that have really come into play. And I feel for the folks that we work with now that are on fixed incomes and really, rely on that fixed income, because we are trying to help them solve for, that retirement income, whether it's 4 or 5 or 6% every single month. So there is some alternatives out there, as I just mentioned.
Thank you for that, DJ. We had another great question. How do you feel about gold as a hedge against inflation? Do you recommend crypto to any of your clients? Under what circumstances would you recommend that to?
Yeah, gold is, for a long time has been known, gold as well as other commodities similar to it have been known as a solid investment type to hedge against inflation. Depends though, because the value of a commodity can fluctuate the same way the value of a stock can, right? Sometimes even more. And so a good example is, inflation is kind of running rampant right now. If we're comparing to where it was last year, and gold isn't really doing much, I should say, to protect against that, right? So it depends. It could be a good way to diversify and have some of your funds, like we talked about, in a different type of asset that can do well with maybe other, traditional stocks and bonds and mutual funds aren't. A different way to let that particular money in that asset grow over time, such as gold. Crypto, very common, right? In terms of the interest in it. Crypto is very volatile, right? As everybody probably knows, very volatile. Maybe has a growth potential for down the road, but it just hasn't been around long enough to provide, data that shows that it is a reliable asset type to build, for example, serious retirement money, right? I'm not saying that it's a bad thing to invest in it and to have a portion of your net worth in it to try to grow it as much as you can. But it's important to know with crypto, it will be a volatile investment type that will swing drastically in the short term. So hopefully that answers the question.
It does. Thanks, Carl, for that. We also had a question from that just came in. If you don't need the income, are there any pros to taking your Social Security retirement income before the mandatory age?
Sorry, I was just reading a note here. Say that one more time, Sal. Sorry.
Carl, I'll go ahead and
Okay.
take this one in regards to Social Security. And, what's interesting, we do 2 events a year at Wescom specifically to our membership on Social Security because it's such a big topic. In fact, we get so many questions and they're so specific to individuals. What's interesting is there's so many sides to this argument. And the first side is, as soon as I hit 62, I'm going to go ahead and take those funds because I don't know if they're going to be there in the future. Now, clearly taking them at 62 is going to discount your Social Security. And there's a factor. And what's great is when you go to the Social Security site, you're going to see a discount, which is typically 85% of what you would receive. So instead of receiving, let's say, $1,000, you're going to get $850 for your lifetime. Now, if you look at the other side of that equation, let's say you're able to defer that. So this is what I like telling our members when we sit down with them is if I could show you a way to earn an additional 8% per year, would you be interested? And how you do that is just by deferring your Social Security. Now, again, you're going to defer each year up to your maximum age, which is age 70. So that gives you 8% deferral each year. And based on, when, of course, you're going to take Social Security and what your age is, typically it's about a 32% return from your age of full eligibility all the way up to deferring it. So again, it really depends. But what we wouldn't want to see an investor do and someone do is to take Social Security and then just end up putting that into their bank account. Because again, we know what rates are right now in a savings account, it's 20 or 30 basis points. And if you know you can include or increase your Social Security by 8% per year, it's something to take a look at. So, again, I would definitely encourage everyone to sign into that Social Security webpage. You can download your statement there and just kind of take a look at the differences of whether it's 62 or maximum age at 70.
Yeah, and I'd add to that, DJ, that that's I think where the importance of maybe kind of sitting with somebody to kind of walk you through what that would look like, because there's strategies behind when to take Social Security, when it makes sense to do it, if there's other assets that you can maybe use for income while you wait to take Social Security, right? Got to keep in mind, we can start Social Security at 62, but like DJ said, there's about a 30% decrease that you receive from the actual amount that you're supposed to get at full retirement age. For most folks born after 1960, full retirement age is 67 years old, right? So again, there's ways to still have income in retirement in a strategic way to postpone taking Social Security, or vice versa, right? If you wanted to take Social Security first, there's different strategies to make your investments or your assets grow so you can supplement your income down the road, right?
Thank you for that, Carl. Thank you, DJ. Just to let everyone know, we're up against it in terms of time. I appreciate everyone's questions that were asked. Sorry if we didn't get to address all the questions that were in the chat room, but I think we got through most of them. I know one question that came through DJ and Carl, and this is more to do with a programming type of information. Do we have more in-depth presentations that are available that we can touch in that WFS, Wescom Financial Services, has to offer?
Sal, I'll go ahead and take that. And then Carl, anything you want to follow up on. One of the things that we've done at Wescom is we want to make sure that we're providing financial literacy to our membership every single day. And so just like the UCLA community with our membership, absolutely these are open events for everyone to attend. So we do 10 events a year. We do one a month, and these are open to our membership. They're also open to all of you and various topics. So we will talk about Social Security. We are actually doing one next month on cryptocurrency and just understanding what that is and would that make sense for me. We're also going to be talking about Medicare. Some of the other topics will be estate planning and should I set up a trust and a will. So these are various topics. So from February all the way to November, we have these 10 events. In addition to that, there is some general information, of course, on our webpage. but nothing beats the one-on-one connection that Carl is available to provide to all of you. Whether it's a virtual appointment, we're doing a lot of Zoom appointments, and so that could be another way to connect with Carl and just say, you know, I'd really like to learn about my situation and ask you some more specific questions.
Yeah, I'd piggyback on that, DJ. The information is there definitely that we, you know, that folks can find online, but I think there's something about kind of sitting with somebody to understand your personal situation and provide advice that I think is important. Again, because everybody's situation can be a little bit different, and these investment types and strategies often can be kind of complex. So, you know, I think sitting with somebody is definitely helpful. Hey, Cindy, I will get your question, I promise. I see that you had a question regarding the 4% rule in terms of withdrawals from your retirement account. So you mentioned that they heard the 4% rule is not really a good rule anymore. Potentially, right? It depends, because the 4% rule for folks that aren't familiar with it essentially says that if you withdraw 4% of your retirement assets, that is a percentage that you can withdraw every year from your retirement accounts that will allow you to not run out of money in retirement, right? That will provide you the income that you need without having to worry about your account going to zero, right? The reason it's being debated now that it's not such a good rule anymore is simply because what we were mentioning earlier is that bonds don't produce the returns that they maybe did prior to maybe 2008 when the Great Recession hit, right? However, there's different investment strategies. We covered annuities very briefly. There's different type of annuities that are very effective in providing a higher income amount than 4% and providing income that you don't have to worry about running out, right, from a retirement account. And again, that's not to get too specific with it, but that would be a strategy that you can use. Again, to look at a specific situation more in depth, I'd say to Cindy and to everybody, if you guys want to set some time aside and talk more about your situation, I think that would be helpful and probably beneficial to look at. But the 4% rule is still utilized. Again, it all depends on your personal situation, but there are more in-depth strategies that can be used just as effective or more effective than that.
And Carl, I'll just add one more thing onto that. There's a theory, or I guess it's a term we use called the sequence of returns. And that's really important because what that basically is saying is what we don't want to see happen is if we sign an individual up to start the 4% return on their account and we go into a situation where we have a market correction, you know, we want to make sure that as Carl said, that we have longevity for the principal. So there's a lot of ways to approach that. And a lot of times it's not even touching your account, but touching other resources that may be available before we touch that retirement account. And so a sequence of returns is basically just a discussion about, we want to make sure before we turn that 4% on, are we going to have a market correction? Because I know we did see that in 08, 09, where we had individuals starting retirement and we had a market downturn as well as a 4% withdrawal starting from their account. And it could really put someone's retirement in jeopardy if that happens. So there's a lot of ways and programs out there that we actually utilize to make sure. So that's a little bit more background about the 4% rule, because I know a lot of people are questioning that. And is that really the right amount? And, you know, how do you actually set that up and go about implementing that? So.
DJ, Carl, thank you so much for that. Great questions. Thank you for touching on all that, all the questions and providing great information. For those of you still turning in, I want to congratulate the person that was randomly selected for the $50 UCLA Store gift card. Drum roll for All in Touch. Bill Ratner. Bill, thank you for asking your questions this evening. Bill, you are the lucky winner of our $50 UCLA Store gift card. I'll be in touch with you, Bill, and we'll send that to you. It's going to be sent to you via electronically. So be expecting that soon, Bill. So once again, congratulations. So with that, we're going to conclude. I want to turn this back over to Jeanette. And Jeanette, take it away. Thank you again for allowing us to present this evening. And thank you once again on behalf of DJ and Carl.
Thank you, Sal, and thank you, Bruce, for joining us tonight. This program was recorded, and we will send you the link once it's posted to the Alumni Association's YouTube channel. Again, thank you, Wescom's David and Carl and Irvin from UCLA Gift Planning. Have a good evening and go Bruins.